Every trader experiences it. The sinking feeling in the pit of the stomach when a trade goes against you, the relentless frustration as losses mount despite your research and effort, the gnawing doubt that maybe the market is designed to defeat you personally. Losing money in trading is universal. It spares no one. Yet, the perception that losses are random and uncontrollable is one of the most dangerous misconceptions in trading. Every loss, every failed trade, every moment of regret follows patterns that can be analyzed, understood, and ultimately controlled. There is a rhythm to losses, a predictable cycle of mistakes and missteps that keeps traders locked in a perpetual cycle of disappointment. The first step to breaking this cycle is recognizing that losing is not an accident, it is a symptom of decisions, strategies, and psychology failing to align. Every trader who has suffered through multiple losing streaks has unknowingly approached the edge of what I call the turning level, the precise point at which the combination of discipline, strategy, and mindset coalesces to stop losses from dominating the account. The turning level is not a mystical point on a chart or a single price marker in a market. It is a threshold in behavior and thinking, a convergence of skill, patience, and self-control. It is the invisible line where traders stop bleeding capital because they have adjusted every aspect of their approach to minimize unnecessary risk. The turning level exists for every trader, but most never reach it. Many continue trading blindly, believing that persistence alone will eventually yield profits. The market is not a meritocracy. It does not reward effort alone. It rewards strategy executed with discipline and guided by an unshakable psychological framework. Losses before the turning level are rarely about the market itself. They are the result of inconsistent strategy, overexposure, emotional decisions, impatience, and poor risk management. Traders often chase the wrong signals, take positions without defined exit strategies, or violate their own rules repeatedly. Each violation compounds losses, erodes confidence, and blurs judgment. Recognizing these patterns is critical. Without awareness of what triggers losses, a trader cannot hope to reach the turning level. Losses are predictable, measurable, and preventable. They manifest in recurring mistakes, overtrading, chasing losing trades, failing to respect stop-loss orders, reacting impulsively to price movements, letting greed override logic, and allowing fear to dictate action. These behaviors are not anomalies. They are the very structure of pre-turning level trading. Awareness alone is not sufficient. Understanding how and why these patterns exist allows traders to begin structuring their actions toward a level where losses become minimal. The turning level is more psychological than technical. Charts, indicators, and algorithms play a role, but without mastery of the mind, technical skills alone will fail. Emotional regulation, patience, discipline, and adherence to rules determine whether a trader survives long enough to reach this level. Traders who reach it do so because they stop reacting and start planning. After all, fear is replaced with calculated confidence. After all, each decision is executed within a framework designed to protect capital and maximize opportunities. The turning level is reached not when the market changes, but when the trader changes. Real trader experiences demonstrate this principle repeatedly. Consider a trader who consistently loses 5 to 10 trades in a row, each time increasing position size to recover losses, only to suffer even greater setbacks. The losses continue until a shift occurs. Stop losses are honored, position sizing is controlled, the trading plan is followed, and emotional reactions are neutralized. Suddenly, trades no longer erode the account. The turning point is unmistakable. There is a moment when losses stop defining outcomes and trading becomes a process rather than a gamble. Traders often describe this as a breakthrough, but it is less a mystical revelation and more a conscious alignment of strategy and psychology. The turning level is invisible until it is reached. No indicator will flash a signal. No chart pattern will reveal it. It is discovered through consistent adherence to disciplined practices, recognition of mistakes, and unwavering focus on risk management. Reaching it requires self-awareness, patience, and willingness to confront uncomfortable truths about behavior and decision-making. Many traders never reach it because they refuse to confront these truths. They continue believing in luck, hot streaks, or secret signals, never realizing that the true turning level is internal. To understand the turning level is to understand the anatomy of trading losses, to map patterns of behavior that consistently produce negative outcomes, and to restructure actions toward consistent, disciplined execution. Traders who reach it experience a profound transformation. The fear of losing no longer dictates decisions, emotional impulses are controlled, and losses are minimized not by avoiding trades, but by trading with precision and discipline. This is the point at which traders stop losing in any meaningful sense, where their accounts cease to erode due to repeated mistakes, and where confidence replaces panic. It is an achievement of mastery, not magic, a reflection of control over self rather than over the market. Most traders never discover it, and those who do almost never talk about it. The turning level is deeply personal, unique to the trader's psychology, risk tolerance, and strategy. It is the secret level that changes everything, the threshold beyond which consistent performance becomes possible. Recognizing the turning level requires humility, patience, and relentless observation of patterns in both the market and oneself. It demands that every trader analyze every loss, question every impulse, and adjust every aspect of behavior that contributes to repeated setbacks. The turning level is not a destination marked by profit alone. It is defined by freedom from destructive losses, by the ability to execute trades with precision, and by the mindset that ensures survival and growth in any market condition. To reach it is to take control of the trading journey, to convert chaos into structured, disciplined action. It is the point at which traders stop losing, not because the market is easier, not because strategies suddenly work, but because the trader has become the limiting factor no longer. The trader has evolved, disciplined behavior replaces reckless impulses, and consistent outcomes become achievable. The turning level is the threshold every trader seeks, the invisible line between failure and mastery, and the starting point for consistent, sustainable trading success. There is a level in trading that few ever reach, a hidden threshold where the chaos of the market stops devouring accounts, where fear no longer dictates decisions, and where losses that once felt inevitable vanish into a distant memory. This is the turning level, and it is less a place on a chart than a dark mirror, reflecting every weakness a trader has ever harbored. It exists in 3 dimensions, each more elusive and terrifying than the last, and each one must be confronted alone. The first is the risk management threshold. This is where losses that once bled your account dry are suddenly contained, measured, predictable, and insignificant compared to the threat they once posed. Before reaching this threshold, a single misstep feels like a predator lunging from the shadows, unstoppable, unavoidable, ready to devour every hard-earned dollar. Trades executed without discipline, over-leveraged positions, ignored stop losses. All of it disappears into careful calculation and respect for the rules that protect you from the abyss. Every decision is a shield, every risk assessed and confined. The second dimension is the consistency threshold. Here, the balance shifts. The trades that once haunted you like ghosts now begin to favor you. Wins quietly outnumber losses, not by luck, not by chance, but by the terrifying precision of method and repetition. The market, once a storm of unpredictable horrors, now bends to the structure of disciplined practice. Each entry, each exit, no longer feels like stepping onto thin ice over black water, but a measured, cautious march through the dark. The final dimension is the psychological threshold. This is where fear stops screaming in your ears, where panic no longer seizes your hands, and where hesitation no longer controls your actions. Before crossing it, every red candle, every sudden spike, every unexpected reversal is a specter that drags you toward despair. After crossing it, these same movements are silent, impotent shadows. You are aware of them, but they cannot harm you. The mind, once a battlefield of doubt and anxiety, becomes a weapon of calm observation and cold decision-making. These thresholds are invisible. You will not see them marked on a chart. No indicator will blink to signal their arrival. They reveal themselves only after you have been tested by the market's harshest and darkest days, after you have faced the nights when losses pile like corpses around your account. When every trade feels like a trap set by some unseen, merciless hand, only when you survive these trials and your account emerges intact, your mind unshaken, will you sense that you have crossed the turning level. It is a sensation both exhilarating and haunting, like realizing that you are standing at the edge of a chasm that once swallowed everything you loved, only now to see it frozen, silent, powerless. The risk management threshold, the consistency threshold, and the psychological threshold converge at this hidden point. Each one alone is terrifying, each one a crucible that can destroy the unprepared. Together, they form a threshold few dare to step over, a place where traders become predators of their own fate rather than prey. Traders who reach this level often do not speak of it. To do so would be to reveal the secrets of survival in a world that is merciless and cold, a world where markets rise and fall with indifferent cruelty, where losses wait in every shadow, and every candle has the potential to strike like a viper. It is discovered only through confrontation with these shadows, through nights spent watching balances drain, through the suffocating realization that one misstep could erase months or years of effort in an instant. It is not taught, not charted, not written in guides. It emerges from the crucible of fear itself. The turning level is a dark teacher, unforgiving, patient, and silent. It waits for the trader to falter, to bleed, to despair, and then it whispers the truth. Control, consistency, and calm are the only weapons that will prevent you from being consumed. The horror of trading lies not in the market, but in the mind of the trader unprepared, and the turning level is the antidote, though it is earned in blood and anxiety. To approach it is to stare into the abyss that once devoured your account and realize that the abyss now obeys your rules. Risk is contained, losses are measured, fear is neutralized. The market, for the first time, is a servant of strategy rather than a predator of impulse. Traders who have crossed this threshold understand a truth that haunts those who have not. It is not the market that kills, it is the failure to command oneself, the failure to master the shadows within. Every trade before this point is a ghost, every mistake a haunting memory, every loss is a whisper of inevitability. After the turning level, these ghosts retreat, the whispers fade, and the trader stands alone, armed with discipline, awareness, and a mind sharpened by the horrors endured. You discover this level by surviving the market at its most merciless, by enduring streaks of losses that would break weaker wills, by watching every plan collapse only to rebuild with meticulous precision. You discover it when the fear that once ruled your decisions is finally silent, when panic no longer drives exits, when hesitation no longer guides entries, and even then, the recognition is subtle. There is no triumphant signal, no chart pattern declaring victory. There is only a calm certainty, a sense of survival that feels both empowering and chilling. It is the hidden threshold where the trader stops losing, where every prior failure transforms into a guide for survival, and where mastery begins not with victory, but with control. It is a place of darkness, silence, and discipline, a place few ever reach, a place where the mind becomes sharper than any indicator, colder than any trend line, and stronger than any market storm. It is not on your charts, and no indicator will tell you. You discover it only by testing yourself against the market's toughest days, by walking through the shadows until they obey you, and by confronting the horrors that every losing trader fears most. This is the turning level, the hidden threshold, the point at which the nightmare ends and control begins. Most traders think they lose because the market is against them. But the real enemy is closer than they realize. It is in their own hands, in the trembling of their fingers on the keyboard, in the pounding of their hearts as candles flash red, in the whispered justifications that lead to ruin. Overtrading is the first symptom, the relentless compulsion to enter every perceived opportunity, to chase movement like a moth to a flame, to ignore exhaustion and reason alike. Accounts are drained not by one mistake, but by 1,000 small impulses, each trade executed with desperation, each loss compounding the fear that drives the next reckless move. The screen becomes a reflection of obsession, each chart a siren calling for attention, each beep a heartbeat counting down to disaster. Ignoring stop, loss is the second betrayal, a conscious decision to flirt with danger, to pretend that control exists where it does not. The stops that should protect become ignored, overridden, dismissed as unnecessary, until one candle wipes out months of careful accumulation. Traders convince themselves that the market will turn, that patterns will hold, that luck can be defied. But the market has no mercy. Chasing losses is a ritual of despair, a cycle of punishment where every attempt to recover only deepens the wound. A trader loses 100 points and enters the next trade larger, riskier, convinced that the void can be filled. The void, however, is insatiable. It waits, patient, indifferent, and it consumes every miscalculated move, every rationalization, every moment of arrogance. Emotional trading is the final manifestation, where greed and fear intertwine, where decisions are made not with strategy but with desperation. A surge of hope triggers a buy, a flicker of doubt triggers a sell, every impulse masquerades as insight, every action justified by illusion. Even skilled traders, those who can read charts, understand trends, and analyze data, succumb without discipline. Their knowledge becomes meaningless when emotion dictates position sizing, entry points, and exits. One trader, proficient in technical analysis, ignored his stop, loss repeatedly, believing that his understanding of support would protect him. A single reversal wiped out weeks of profit and left him paralyzed for days, staring at a screen that reflected his own failure. Another adept at reading candlestick patterns, overtraded after a small loss, chasing wins with increasing leverage until a sudden spike turned confidence into terror and wiped his account clean. Discipline is the invisible shield. Without it, skill alone invites destruction. The anatomy of losing traders is consistent: the obsession with action, the neglect of protection, the compulsion to recover, the surrender to emotion. These are not random weaknesses. They are predictable, recurring patterns that trap even the most knowledgeable in cycles of failure. Every trader has experienced the sensation, the heart racing, the mind rationalizing, the hands itching to act, the vision narrowed to the immediate movement of price, blind to the larger consequences. Losses pile like corpses in the shadows, each one a reminder that knowledge without restraint is a curse. Relatable stories emerge from the darkness. A trader staying awake for 24 hours to catch a small movement, only to enter a position moments before a sudden reversal. A trader who doubled down after a minor loss, believing in inevitability, only to see margin calls erase months of careful management. A trader who allowed fear to dictate exits, selling too early and watching profits evaporate like smoke in the night. Every story is a lesson in horror, a reflection of the internal predator that devours undisciplined traders. These patterns persist because the mind seeks immediate reward. After all, loss triggers panic because desire overrides reason. Overtrading creates the illusion of control. Ignoring stop losses feigns bravery. Chasing losses masquerades as courage. Emotional trading disguises fear as insight. The market does not forgive these illusions. It does not wait. It strikes with precision and indifference, and those who ignore the anatomy of their own failures are left to wonder why they cannot survive despite skill. The true horror is not in price movements, not in sudden reversals, not in economic events. It is in the reflection staring back from the screen, in the trader who convinces themselves that they are clever, who rationalizes every misstep, who blames charts, news, or luck while the real enemy is their own lack of restraint. Every failed trade, every lost account, every moment of despair is a symptom of this anatomy, the addiction to action, the abandonment of protection, the obsession with recovery, the surrender to emotion. Recognition of this pattern is the first step toward survival, the prelude to crossing the turning level. Until a trader sees themselves clearly, until they confront the impulse that drives overtrading, the disregard that ignores stop losses, the desperation that chases losses, and the emotion that overrides reason, they remain prey in a market that is patient and unyielding. Awareness is not enough. It must be coupled with action, with discipline, with an unrelenting commitment to rule-based behavior. Only then does the shadow lift. Only then does the trader begin to regain control. Only then do the terrifying patterns lose their grip. The anatomy of losing traders is universal. It lurks in every account, in every hesitation, in every impulsive click. It is recognizable in hindsight, terrifying in experience, and lethal if ignored. Every trader who wishes to survive must map these vulnerabilities, must examine the skeleton of their mistakes, must dissect the impulses that drive them toward ruin. The horror is intimate. It lives in the mind, not in the market. Every skilled trader can fall victim because the enemy is not outside but within. Mastery comes when a trader identifies this anatomy, recognizes its manifestations, and builds structures to counteract it. Then, and only then, does the turning level emerge as a possibility, as a hidden threshold where losses no longer dominate, where control replaces fear, where the mind becomes a weapon of survival rather than a conduit for destruction. Until that point, every screen is a mirror of weakness, every candle a reminder of mortality, every loss a whisper of inevitability. The anatomy of losing traders is precise, merciless, and haunting. To understand it is to glimpse the truth that most will never face. The market does not kill traders, their own habits do, and without confronting these habits, survival is impossible. Traders often skip this stage, rushing straight to strategy, only to be humbled by their first streak of losses. Preparation before reaching the turning level is not optional. It is the foundation on which survival and eventual mastery are built. Journaling every trade is the first step, a practice that exposes patterns invisible in real time, a mirror reflecting mistakes, impulses, and recurring weaknesses. Every entry, every exit, every decision must be recorded with precision, including the rationale, the emotional state, the external conditions, and the outcomes. Without this discipline, errors repeat in silence, unrecognized and uncorrected, leaving traders trapped in cycles of failure. Mastering one strategy is the second pillar. Diversifying too early or chasing multiple approaches creates confusion and dilutes focus, making consistency impossible. A single, well-understood strategy executed with rigor allows traders to observe patterns, refine timing, and develop confidence while minimizing unnecessary risk. Depth of understanding outweighs breadth of experimentation, and mastery emerges not from complexity, but from repetition and disciplined execution. Setting risk limits is the third critical component. Every trade must be bound by clearly defined parameters, including maximum acceptable loss per trade, total daily exposure, and worst-case scenario planning. These limits are non-negotiable boundaries that prevent a series of small errors from cascading into catastrophic account depletion. Understanding leverage is equally essential, for excessive leverage magnifies errors and accelerates losses. Traders must quantify the impact of leverage on both winning and losing trades, recognizing that even minor miscalculations can erase months of careful accumulation. Leverage is not a tool to increase profit potential without consequence. It is a weapon that can either amplify disciplined action or magnify mistakes into irreversible damage. Emotional preparation is the invisible architecture supporting all technical measures. Fear and greed are not optional reactions. They are constants in trading psychology. Traders must anticipate emotional triggers, including panic during sudden losses, elation during winning streaks, and the compulsion to act impulsively. Mental exercises designed to strengthen discipline include visualization of adverse scenarios, rehearsing responses to unexpected reversals, and developing routines that impose calm and structure. These practices condition the mind to remain composed when confronted with volatility, ensuring that decisions are guided by strategy rather than impulse. Pre-turning level preparation also involves setting clear objectives and metrics for performance, defining success in terms of adherence to rules rather than immediate profit. Traders must accept that losses are part of the process, that mistakes will occur, and that the goal is to control exposure, preserve capital, and reinforce disciplined behavior. The combination of journaling, strategy mastery, risk limits, leverage understanding, and emotional conditioning forms the invisible scaffolding upon which the turning level is approached. Each component reinforces the others. Disciplined journaling reveals emotional patterns, understanding leverage informs risk limits, strategy mastery reduces reactive decision-making. Ignoring any element leaves gaps that the market will exploit. Traders who skip preparation overestimate their ability to control outcomes, underestimate the psychological toll of repeated losses, and fail to anticipate the subtle, compounding errors that precede account depletion. Those who commit to structured preparation gain clarity, resilience, and the ability to recognize early warning signs before they escalate. The practice of journaling every trade allows the trader to extract actionable insights from each success and failure, transforming experiences into data that guide future decisions. Mastering one strategy builds confidence and reduces cognitive overload, preventing paralysis by analysis and impulsive deviation. Setting strict risk limits and understanding leverage converts technical knowledge into protective measures that mitigate the inherent dangers of trading. Emotional preparation, through mental exercises and anticipation of psychological challenges, creates a stable internal environment where decisions are deliberate rather than reactive. This stage is the quiet crucible in which the trader's discipline is forged. Traders may find it tedious, frustrating, and slow, but it is indispensable. Every hour spent refining processes, every page of trade notes, every rehearsal of mental responses, and every measured application of risk boundaries compound into a framework capable of sustaining performance under pressure. Without this foundation, the turning level remains unreachable, a theoretical construct rather than an achievable threshold. Preparation transforms uncertainty into manageable variables, fear into strategy, and randomness into a structured approach. It aligns the trader's actions with their objectives and fortifies resilience against the inevitable challenges of volatile markets. Traders who commit to this phase often experience an initial discomfort as they confront their own weaknesses and habitual errors, but this confrontation is necessary. It is a controlled exposure to the same pressures that previously led to destructive behavior, allowing the trader to respond consciously rather than react unconsciously. The disciplined execution of pre-turning level practices conditions both mind and account to withstand stress, prevent avoidable losses, and recognize the subtle signals that indicate when a strategy is functioning or failing. This preparation stage is not about immediate profit. It is about survival, control, and creating conditions where consistent performance becomes possible. Each practice, journaling, strategy mastery, risk management, leverage comprehension, and emotional conditioning, interlocks, creating redundancy and reinforcing the trader's capacity to withstand errors, uncertainty, and volatility. Skipping even one aspect introduces vulnerability that can unravel progress, demonstrating that mastery is systemic rather than incidental. Traders who invest in this preparatory phase emerge equipped not only with technical skills, but with the mental and emotional fortitude required to confront markets that are unpredictable, indifferent, and relentless. They gain insight into their own tendencies, recognize vulnerabilities before they manifest as losses, and cultivate a mindset where strategy dictates action rather than emotion. Pre-turning level preparation is the gateway to the hidden threshold where losses cease to dominate. It is rigorous, demanding, and often uncomfortable, yet it is indispensable. Without it, traders are exposed to the full force of market volatility, prone to the predictable patterns of overtrading, excessive risk, and emotional impulsivity that doom the unprepared. With it, they approach the turning level equipped with insight, discipline, and resilience. This stage defines the difference between those who survive trading long enough to discover their own hidden thresholds and those who are consumed by the market before they have the chance to test themselves. Every successful trader recognizes, retrospectively, that preparation determined the outcome more than any specific trade or strategy. It is the invisible architecture that supports consistent action, the uncelebrated work that precedes visible success, and the stage that separates the reckless from the deliberate, the reactive from the strategic, the traders who are consumed from those who endure. Preparation is not optional. It is the first, most critical threshold in the journey toward the turning level, the stage where discipline is built, risk is controlled, and the mind is armed against the inevitable pressures that lie ahead. Mastery begins here, in the meticulous, deliberate, and uncompromising construction of practices that allow a trader to confront the market without fear, to act with precision, and to cross the threshold where losses cease to dominate and performance becomes consistent. The same strategy can make a trader either fail or thrive. It's all about the level at which it's executed. Risk-reward ratio is the foundation of any strategy at the turning level. Every trade must be evaluated not only for potential profit, but for potential loss, and the relationship between the two dictates whether an account survives or collapses. A trader who ignores risk-reward invites destruction, while a trader who enforces disciplined ratios ensures that even a series of losing trades does not compromise long-term performance. Position sizing is equally critical, determining the magnitude of exposure relative to account size and market volatility. Excessive position sizing amplifies errors, creating vulnerability to fluctuations that would otherwise be manageable. Conversely, precise position sizing allows the trader to remain in the market longer, absorb adverse moves, and execute strategy without emotional compromise. Trend following is another cornerstone, allowing traders to align with prevailing market forces rather than attempting to predict reversals or force entries against momentum. At the turning level, identifying clear trends and executing trades in harmony with them transforms uncertainty into calculated opportunity. Stop-loss placement is not optional. It is a defensive measure that converts hypothetical risk into controlled, manageable outcomes. Without stops, even the most promising strategy collapses under sudden adverse movements. Effective stop-loss placement is based on volatility, support and resistance levels, and market structure, ensuring that exits are logical, consistent, and enforceable. Mechanical, rule-based trading works better than impulsive trading because it removes emotion from decision-making. The turning level is not a place where intuition alone can be trusted. It is a threshold where precision, discipline, and repeatability dominate. A trader following a strict rule-based system executes entries and exits according to predefined conditions, avoiding panic-induced errors, overtrading, and reactive decisions. Impulsive trading, by contrast, is vulnerable to fear and greed, producing inconsistent results and exposing the account to avoidable losses. Patience is the final attribute that defines strategy at the turning level. It is the restraint to wait for high-probability setups, the discipline to ignore noise, and the confidence to execute only when conditions align with established rules. Frequent action may feel productive, but without patience it becomes a path to repeated loss and emotional exhaustion. The combination of risk-reward ratio, position sizing, trend following, and stop-loss placement creates a structured framework that transforms strategy from theory into actionable, repeatable practice. Each element reinforces the others. Disciplined position sizing enhances the effectiveness of risk-reward ratios, trend alignment increases the probability of success within defined risk parameters, and stop-loss placement preserves capital when outcomes deviate from expectations. Mechanical execution ensures that the framework operates consistently, while patience ensures that trades are selected selectively and thoughtfully. Even minor deviations from these principles can dramatically alter outcomes. A trader with perfect technical analysis but poor position sizing will experience losses that erode confidence. A trader with excellent risk management but impulsive entries will repeatedly violate rules, producing inconsistent results. Only when all elements are integrated and applied consistently does strategy reach its full potential at the turning level. Practical application requires adherence to predefined entry and exit rules, meticulous calculation of risk per trade, careful selection of position size, alignment with trends, and placement of logical stop-loss orders. It demands discipline in execution, emotional control, and a commitment to observe rules without exception. The turning level is not a guarantee of success, but it creates conditions under which consistent performance becomes achievable, losses are contained, and trades are executed according to rational, repeatable principles. Traders who implement these strategies at the turning level find that account erosion becomes rare, performance stabilizes, and confidence is no longer dictated by short-term results. Every trade becomes part of a larger, structured process designed to manage risk and maximize opportunities. Deviations are minimized, decisions are deliberate, and performance is sustainable. Even experienced traders can fail if they neglect any component of their strategy. Risk-reward ratios ignored in pursuit of large gains, position sizing misaligned with account balance, trend signals misread or ignored, stop losses placed arbitrarily, impulsive trades executed without confirmation, all result in rapid losses that undermine progress. Success at the turning level is contingent on consistency, precision, and adherence to proven principles rather than intuition or impulsive action. The framework is adaptable to different market conditions, but only when execution is disciplined. Strategies alone are inert, their effectiveness emerges when applied methodically, consistently, and in alignment with the principles that govern the turning level. Traders who reach this stage recognize that the market does not reward effort alone, but disciplined, rule-based execution over time. They understand that even the most sophisticated system fails without structure, patience, and risk management. The same chart pattern, indicator setup, or signal can produce dramatically different outcomes depending on the trader's execution, psychological state, and adherence to strategy. Mastery lies in eliminating randomness from execution, containing risk, and preserving capital while exploiting market opportunities. The turning level is where strategy ceases to be theoretical and becomes actionable, measurable, and repeatable. Trades are executed with precision, losses are minimized, and outcomes become a reflection of disciplined decision-making rather than chance. Patience, mechanical adherence to rules, proper risk-reward evaluation, position sizing, trend alignment, and logical stop-loss placement converge to create a system capable of producing consistent performance. Deviations, impulsive actions, or emotional interference introduce variability that can undo months of preparation. At this level, strategy is inseparable from execution, and the trader's mindset is the ultimate determinant of success. Every trade is a test of discipline, every outcome a measure of adherence, and every error a signal for adjustment. The effectiveness of strategy is amplified not by complexity, but by consistent application, mental fortitude, and unrelenting adherence to the principles that define the turning level. Traders who reach this point operate within a controlled framework where risk is quantified, decisions are deliberate, and losses are contained, allowing performance to stabilize and grow. The same strategy that would destroy an unprepared trader produces consistent gains for one who executes with discipline, patience, and precision. This is the power of the turning level, the convergence of method, psychology, and execution into a system that transforms theoretical potential into measurable, repeatable, and sustainable performance. The market remains indifferent, volatile, and unpredictable, but the trader's disciplined approach ensures that risk is managed, opportunities are seized, and outcomes are determined by rules rather than chance, emotion, or reaction. Mastery emerges not from prediction but from preparation, control, and disciplined execution, transforming strategy into a weapon of consistent advantage. Before reaching this mindset, traders react. After it, they adapt. Few ever realize the difference until it's too late. The mindset shift at the turning level is the defining transformation that separates reactive traders from disciplined, consistent performers. Emotional mastery is the foundation. Fear must be converted into discipline, the compulsion to exit prematurely or panic during losses replaced with measured, rule-based responses. Greed must be converted into patience, the impulse to overtrade or chase unrealistic gains replaced with restraint and calculated opportunity. This shift begins with awareness of emotional triggers, the recognition that every fear-induced exit or greed-driven entry has cost more than the market itself. Discipline emerges when a trader develops the capacity to act only within defined rules, resisting impulses even under extreme market volatility. Patience allows the trader to wait for setups that meet all criteria, avoiding the constant lure of the noise, the small fluctuations that once provoked unnecessary action. Mindset transforms small gains into consistent profits by enforcing a long-term perspective where every trade is part of a structured plan rather than a desperate attempt to recover losses or accelerate wealth. Traders learn to accept small, repeated gains as the compounding force that builds sustainable performance, understanding that chasing large, erratic wins exposes accounts to ruin. The mental stop loss is a critical concept in this stage, extending beyond numbers on a chart or pre-calculated risk. It is a self-imposed boundary, an internal discipline that dictates when to walk away from a trade, a market, or even a session. The mental stop loss prevents escalation of risk driven by emotion, ensuring that the trader maintains composure and preserves capital under conditions that would previously have induced panic. This practice requires self-honesty, clarity of rules, and the ability to act preemptively rather than reactively. Emotional mastery, patience, and mental stop loss converge to create a mindset where decisions are deliberate, outcomes are predictable within probability, and risk is contained even when the market behaves unpredictably. Traders at this level no longer feel at the mercy of volatility. They operate within a framework that transforms uncertainty into actionable decisions. The mindset shift also reinforces consistent strategy execution. A trader with a disciplined mindset avoids deviation from tested methods, adheres to risk-reward protocols, and maintains position sizing according to rules rather than impulse. Greed no longer drives over-leveraging, fear no longer triggers early exits, and the mental stop loss prevents cumulative errors from escalating. Small gains are accumulated and compounded because each trade is executed within a controlled environment where emotion is managed, rules are followed, and psychological stability ensures rational decisions. Psychological resilience is enhanced through repeated practice, reflection, and observation of past emotional responses. Journaling of trades and emotional states reinforces awareness, allowing the trader to identify patterns of reactive behavior and replace them with disciplined responses. Over time, the mindset shift becomes ingrained, automatic, and unbreakable under stress. Even in periods of loss or volatility, the trader remains calm, rational, and disciplined, understanding that long-term performance depends on consistency rather than short-term reactions. The mental stop loss becomes a safeguard against both internal and external threats, ensuring that neither greed nor fear dictates actions, and that strategy continues uninterrupted despite temporary setbacks. Mastery of mindset ensures that small, methodical gains are recognized, captured, and compounded without interference from emotion. Traders with this shift understand that the market rewards consistency over heroics, that sustainable performance comes from discipline rather than prediction, and that survival and compounding are more valuable than isolated wins. The mindset shift also encompasses confidence, a calm assurance in decision-making derived from preparation experience and repeated adherence to rules. This confidence is not arrogance, it is recognition that actions are deliberate, informed, and aligned with probability. It allows the trader to remain unmoved by short-term fluctuations, to trust their strategy, and to apply mental stop-loss boundaries without hesitation. The transformation from reactive to adaptive is evident in behavior. Entries are timed precisely, exits follow predetermined rules, risk is contained, and patience governs every decision. The trader no longer chases outcomes but enforces process, no longer reacts to market fear or greed but anticipates scenarios and implements measured responses. This mindset converts vulnerability into advantage, transforms small gains into sustainable performance, and preserves capital through disciplined control. Emotional mastery, patience, and mental stop-loss reinforce each other. A disciplined mindset reduces impulsive actions, a patient approach allows selective opportunity capture, and mental stop-loss ensures consistent risk containment. Together, they create a psychological framework that allows the trader to operate above the fray, to treat volatility as manageable rather than threatening, and to extract consistent profits from markets that previously induced fear and error. The mindset shift also redefines perception of losses, framing them as feedback rather than punishment. Traders recognize that controlled, measured losses are part of a probabilistic system, and that emotional reaction to losses destroys performance more than the losses themselves. This understanding reinforces patience, strengthens discipline, and ensures adherence to rules despite temporary setbacks. Traders who achieve this shift gain clarity of thought, focus under pressure, and the capacity to execute strategy without emotional interference. Gains are recognized and captured, mistakes are learned from without panic, and performance stabilizes within defined risk parameters. The transformation is subtle but profound. The trader's mind becomes the ultimate instrument of control, converting chaos into order, impulsive tendencies into structured execution, and small, disciplined gains into consistent, sustainable performance. The mindset shift at the turning level marks the transition from reactive behavior dominated by fear and greed to adaptive, disciplined performance characterized by patience, emotional mastery, and strategic consistency. Mental stop-loss, emotional regulation, and adherence to rules converge to create a framework in which small gains accumulate, risk is contained, and long-term success is achievable. This shift is invisible to outsiders, yet it defines the difference between traders who survive and those consumed by market volatility, between fleeting luck and consistent, repeatable outcomes, and between chaos and mastery. The The turning level is not achieved through skill alone, but through the deliberate transformation of mindset into a tool of resilience, discipline, and sustainable profit. Reaching the turning level is subtle, elusive, and often misunderstood, yet it leaves unmistakable markers in behavior, performance, and mindset. One of the first signs is that losses become small and controlled. Trades that once decimated accounts now result in minimal impact because risk management is precise. Position sizing is calculated, and stop losses are respected without hesitation. Every loss is absorbed rather than feared, every drawdown becomes manageable, and capital preservation replaces panic as the primary objective. Rule breaking stops entirely, the impulsive entries, last-minute deviations, and emotional exits that characterized pre-turning level trading vanish. Traders execute according to plan, every action deliberate, every decision measured, and adherence to rules becomes instinctual rather than enforced. Confidence replaces panic. Volatility no longer triggers adrenaline-fueled decisions or rushed exits. Instead, traders operate with calm assurance, executing strategy consistently while observing market movements with clarity rather than fear. Gains are captured, losses minimized, and the psychological burden of trading diminishes as the mind aligns with disciplined execution. Wins begin to outweigh losses. Consistency becomes visible not in single trades but across sessions, weeks, and months. The pattern of repeated small successes accumulates, reinforcing confidence, validating processes, and establishing a positive feedback loop between disciplined behavior and tangible outcomes. Traders who reach this level can recognize it not only in account performance but in mental and emotional stability. Yet, many who believe they have arrived have not. Some experience temporary winning streaks, attribute them to skill rather than luck or market conditions, and assume mastery has been achieved. These traders are often humbled by a sudden adverse trend, a margin call, or a series of losses that expose residual weaknesses. For example, a trader might follow a disciplined strategy for a month, enjoying consistent gains, only to abandon stops during a single sharp reversal, losing more in one day than in all prior weeks combined. Another trader may have controlled losses and followed rules during normal market conditions, but panics during volatility spikes, revealing that confidence is not yet anchored in experience and psychological resilience. Recognizing the turning level requires observation over time, across varying market conditions, and with consistent adherence to strategy. Temporary success is insufficient. Stability under stress, emotional control, and rule adherence are essential markers. The turning level is characterized by the integration of skill, discipline, and mindset such that deviations are rare and performance is sustainable. Losses are small because every trade is entered with precision, risk is calculated, and positions are sized appropriately. Rule breaking stops because the internalized framework of discipline has replaced impulsive behavior. Confidence replaces panic because experience, preparation, and repeated adherence to rules create certainty in execution. Wins begin to outweigh losses because strategy is applied consistently, emotions are regulated, and process dominates outcomes. Traders who reach this threshold recognize subtle changes in their behavior. Hesitation is replaced with deliberate action. Overtrading is replaced with selective entries, and the urge to chase losses is suppressed by a disciplined understanding of probability and risk management. The turning level is not a moment, but a sustained state in which these markers persist across conditions and timeframes. It is tested not by average days, but by extreme events, sharp reversals, market gaps, high volatility, and unexpected news. Traders at this level survive these events with minimal impact because discipline and preparation govern their actions rather than reaction and emotion. Those who mistakenly believe they have reached it fail these tests, exposing residual weaknesses in emotional control, risk management, or strategy adherence. True recognition requires honest self-assessment, review of trading records, and awareness of how one responds under stress. The difference between perceived and actual attainment is often revealed when the market behaves unpredictably, and the trader is forced to maintain composure, follow rules, and accept controlled losses. Examples are numerous. A trader with a history of impulsive trading may enjoy a week of perfect execution, only to immediately abandon stops during a high volatility day. Another may see gains accumulate over a month, then over-leverage to chase a trend, losing the advantage built over weeks. Yet another may follow rules under normal conditions but panic during consecutive losses, revealing that confidence has not fully replaced fear. Recognition of the turning level is therefore a combination of quantitative and qualitative assessment. Quantitatively, losses are controlled, positions are sized appropriately, and gains accumulate consistently. Qualitatively, the trader experiences emotional stability, consistent adherence to rules, and the ability to execute strategy under pressure without deviation. It is the alignment of performance and psychology that defines the threshold, not any single winning streak or isolated outcome. Markers are observable both internally and externally: calm responses to market events, systematic adherence to strategy, measurable control of risk, consistent accumulation of gains, and the absence of panic-driven behavior. These signals collectively indicate that the trader has crossed the threshold and is operating at the turning level. Achieving it is transformative. Trading becomes systematic rather than reactive, outcomes predictable within probability, and risk controlled rather than feared. Traders operate with a sense of mastery, observing market movements without succumbing to impulses, applying strategy with precision, and managing losses before they escalate. The turning level is therefore both a psychological and operational state, encompassing disciplined execution, emotional resilience, and sustainable performance. Recognition is essential because it validates preparation, mindset shifts, and strategy mastery. It allows the trader to continue refining execution, scaling positions safely, and compounding gains without succumbing to the psychological pitfalls that destroy unprepared traders. Without this recognition, traders may mistake temporary success for mastery, exposing themselves to catastrophic outcomes during unanticipated market events. True attainment of the turning level requires ongoing observation, self-honesty, and testing under varied conditions to confirm that losses remain controlled, rules are followed, confidence persists under pressure, and wins consistently outweigh losses. It is the convergence of these factors over time and circumstance that signals not only survival, but sustainable, repeatable performance. In summary, the turning level is recognized through consistent, observable markers. Losses are small and controlled, impulsive rule, breaking stops, confidence replaces panic, and wins begin to outweigh losses. Traders must test these markers across time and extreme conditions to ensure genuine attainment. Temporary success, isolated gains, or controlled performance under ideal conditions are insufficient. True recognition requires sustained alignment of behavior, strategy, and psychology. Only when these markers persist under stress can a trader confidently assert that the turning level has been reached, separating preparation from practice, impulse from discipline, and reaction from mastery. Reaching the turning level is only the beginning. The real traders know that each day, the market offers a new level to conquer. Maintaining and evolving beyond this threshold requires relentless attention to improvement, constant adaptation, and disciplined reflection. Continuous improvement is the core principle. Markets evolve, volatility shifts, correlations change, and strategies that once worked flawlessly must be refined and optimized. Traders maintain journals not only to record trades but to capture lessons, emotional responses, and insights into behavior under pressure. Each observation is an opportunity to identify subtle inefficiencies, unconscious biases, or small errors that, if left unchecked, can compound into significant losses. Complacency is the silent threat beyond the turning level. Confidence can easily become arrogance, and discipline can wane if a trader assumes that mastery is permanent. Markets are indifferent, relentless, and unforgiving. Any relaxation of focus invites reversal. Traders must continuously test strategies, analyze results, and confront weaknesses even when performance is stable. Refining strategies is an ongoing process. Risk-reward ratios must be reassessed, position sizing adjusted for changing volatility, trend-following signals recalibrated, and stop-loss placement optimized. Adaptation ensures that the systems sustaining success remain effective in new conditions. Even minor inefficiencies can erode gains over time, making incremental improvements crucial. Emotional monitoring continues to be essential. Mental stop-loss boundaries, patience under pressure, and discipline in execution must be reinforced daily, especially as performance improves and temptation to overtrade or deviate from rules arises. Awareness of emotional triggers prevents the gradual erosion of consistency and preserves the psychological resilience cultivated to reach the turning level. Evolution beyond this threshold involves seeing the market as a dynamic system, not a static opportunity. Traders refine their methods based on observed patterns, emerging trends, and personal performance metrics. Journals and data become tools not just for reflection but for proactive adjustment. Observing subtle shifts in price behavior, volatility, and market psychology allows adaptation before adverse conditions manifest as losses. Scaling strategies responsibly is another critical aspect. Growth of capital and account size requires proportional adjustment in position sizing, risk management, and psychological preparation. Ignoring scaling considerations can convert consistent performance into instability, as the trader's risk exposure increases without corresponding adaptation of strategy and mindset. Mastery beyond the turning level is measured not by individual wins or losses, but by the trader's ability to preserve capital, apply strategy consistently, and evolve systems to maintain performance under changing conditions. Each day presents a new challenge: sudden news, volatility spikes, structural shifts, or market anomalies. Traders operating beyond the turning level respond with calm assessment, calculated adaptation, and disciplined execution rather than reaction or panic. Continuous learning is integral. Even experienced traders seek knowledge from new techniques, peer analysis, or historical data to identify potential improvements. Curiosity and humility prevent stagnation, ensuring that mastery remains dynamic rather than static. The mindset of evolution distinguishes good traders from great traders. The turning level marks survival and consistent performance, but ongoing adaptation defines long-term success. Traders recognize that rules, systems, and discipline must be actively maintained and refined, and that previous achievement is no shield against future challenges. Reflection is not passive, it is active analysis. Each trade, each session, each streak, positive or negative, offers information. Patterns of execution, emotional responses, and outcome deviations are evaluated systematically, allowing refinement of processes and reinforcement of strengths. Complacency is countered by deliberate challenge testing strategies under stress, simulating adverse scenarios, and continuously questioning assumptions. Psychological fortitude is reinforced through mental exercises, rehearsal of responses to extreme market conditions, and adherence to internalized rules even when the temptation to deviate arises. This ongoing practice ensures that the trader remains at the peak of discipline, patience, and emotional control. The turning level becomes a platform, not a destination, and evolution is the process that prevents regression. Traders embrace the reality that mastery is iterative, strategies are never perfect, markets are never fully predictable, and emotional vigilance is never complete. Incremental improvement, vigilance, and adaptability transform sustained success into long-term growth. Capital, account health, and performance metrics are preserved because discipline is continuously applied, strategies refined, and emotional mastery reinforced. This approach fosters confidence that is grounded in preparation and reflection rather than complacency or assumption. Traders who maintain this mindset recognize that each day, the market provides a new challenge, a new volatility pattern, or a novel scenario to navigate. Each opportunity reinforces the importance of adherence to rules, consistent application of strategy, and disciplined psychological management. Wins are captured reliably, losses are contained efficiently, and cumulative growth is achieved not through luck or heroic trades but through systematic, deliberate evolution. Beyond the turning level, traders develop resilience that allows them to face uncertainty with composure, transform small gains into compounding advantages, and continuously improve their processes to match the evolving market. Journals, reflection, risk recalibration, strategy refinement, mental conditioning, and disciplined execution converge to form a feedback loop that sustains performance. Mastery is therefore dynamic. Success is preserved and amplified not through singular achievements, but through constant observation, adaptation, and disciplined evolution. Traders understand that stagnation is risk, that unchallenged assumptions invite failure, and that the turning level is only a starting point for the continuous journey of mastery. Reaching it is proof of preparation, discipline, and psychological resilience. Maintaining and evolving beyond it is proof of adaptability, vigilance, and relentless commitment to improvement. Each day presents a new opportunity to test rules, refine execution, and strengthen emotional control. Success is preserved not by resting on previous achievement, but by actively confronting the evolving challenges of the market. Traders who internalize this approach convert the turning level from a milestone into a platform for ongoing growth, compounding both performance and psychological strength over time. Reaching the turning level is not an endpoint, it is the threshold from which sustainable mastery, strategic evolution, and continual improvement emerge. The journey continues as every day, every trade, and every market condition offers new lessons, tests, and opportunities. Traders who recognize this remain vigilant, disciplined, and adaptive, ensuring that success is maintained and expanded, not eroded by complacency or stagnation. Mastery in trading is therefore a living, evolving process, anchored in discipline, informed by reflection, guided by emotional control, and propelled by continuous improvement. The turning level is the beginning, the platform from which the trader navigates uncertainty, compounds gains, and evolves relentlessly, transforming consistent execution into sustainable, long-term mastery.